And from Europe, let's get more into the United States now. The futures regulator, the CFTC, unanimously approved tighter limits on how brokerage firms can use customer funds. It's being coined the MF Global rule. It is, of course, in the wake of MF Global's collapse, where it suspected Jon Corzine, who was in charge, was betting with client money. $1.2 billion of that money is believed to be missing. Now, the CFTC wanted to vote on this sooner, but they didn't, because as I told you last week, it was reportedly because of heavy lobbying from none other than Jon Corzine when he was head of MF Global. And before all of this went down, the vice president was talking about going to Corzine for policy advice, him and the president. So how can we believe politicians or regulators when they say that they aim to regulate the very people that they are advising them on policy, that are advising them on policy? Economist Dean Baker is back with us to help us figure that out and maybe some better solutions. So first, I want to ask you if this video that I'm going to play kind of sums up the problem with regulations in the U.S. If I could roll that.
I literally picked up the phone and called Jon Corzine and said, John, what do you think we should do? The reason why we called John is because we knew he knew about the economy, about world markets, about how we had to respond, unlike almost anyone we knew. And because
So while it's great and all that the regulators passed this rule, how can we really expect regulators to regulate the very people that politicians reach out to for advice? And
it is a huge problem. I mean, it's a problem in every sector, but particularly with finance, just because finance has become so enormously powerful, and they so control the debate. So it's not just that they have a huge amount of money to give to politicians, which of course they do, but they also control the expertise. And, you know, the joke is that if you want to talk to someone from Goldman Sachs, call the Treasury Department. I mean, it's just staffed with people who are from Wall Street. So it's an area where they really do control both ends of the debate. You don't have much choice between the Republicans and Democrats. You know, you can get the Democrats in, you have as many people from Wall Street as with the Republicans, maybe more. So it's certainly a very, very big problem that you have regulatory capture way over the top in the financial sector.
So what do you do as far as the financial transaction tax, which I know you are for, and there is opposition from the United States government, from Timothy Geithner, who said it would burden the banks. When you hear that opposition, are some of the same reasons we're talking about fueling that?
Oh, of course. I mean, they're huge. This is money directly out of the pocket of the financial sector, and that's why they're saying this. And, you know, what we could do is try and shoot down every legitimate concern. So they say, well, burden the banks. Well, yes. I mean, we need to raise money. We're better than to get it from the waste in the financial sector, which is what it would do. They say it would reduce trading volume. You go, that's fine. We had lower trading volume in the 70s and the 80s. Was there a problem? What's the problem? You know, they talk about it going offshore. Some will. But, you know, you have the example of the United Kingdom that has had this tax for centuries. They raise between 2 and 3/10% of GDP. That'd be $30 to $40 billion a year just taxing stock trades. They don't tax derivatives, credit default swaps, all of that. They just tax stock trades, raise a very large amount of money. It doesn't go offshore. I mean, some does, of course, but they still get that much. So the point is we could tear down every legitimate argument they have. At the end of the day, you have people that have a lot of money and a lot of power. Maybe they'll win out, but the point is we could say you don't have a legitimate argument. You just want to take money from people.
You just want to take money from the people.
That's what it comes down to. That's the point. And, you know, again, it's not just being punitive. We need tax revenue. So do you want to pay it? I mean, should we have middle-income people pay it, or should we take it from the waste on Wall Street?
Well, one of the arguments is that banks won't pay it. They'll just pass it along to consumers.
And that we could do the arithmetic on. I wish they were better at arithmetic. If you cut your trades in half, let's say each trade costs you twice as much. You cut the number of trades you do in half, which research shows you will. Guess what? You're paying no more for your trades than you did previously. You're paying twice as much in each trade, but you're only trading half as much as you used to. Very little of this will be passed on to consumers.
So, aside from consumers, I want to talk about, you mentioned how in Europe they have been receptive to this, they have pushed for this. Why is it so different from Europe to the United States? Why is the U.S. so opposed?
I think the financial sector is not quite as dominant in Europe. They obviously have large banks, they have a large financial sector, they also have a large manufacturing sector, they have other voices there. So it's not that, you know, this is the, you know, paradigm of democracy and, you know, virtue and everything, but the point is they're rivals of the financial sector. They saw what the financial sector did to the economy, and the other sectors, other business sectors, want to rein them in. Unfortunately, in the United States, at the moment at least, I don't think those other business sectors are very powerful. Finance is really calling the shots.
So other sectors, would one be labor?
Well, labor, of course, but I'm thinking of other business sectors. I mean, labor is willing to support this, and the unions do support a financial transactions tax. But you're going to need to go beyond labor. I mean, as much as I love labor, you know, we're just talking about a little over 10% of the workforce. You're not going to do it with labor alone.
Okay, and just quickly, because we were talking about Europe and we were talking about kind of the impetus there to make a decision, I just want to get back to one thing, because in Europe, they really have this sense of urgency because their borrowing costs have soared. You know, we've seen Italian yields be over 7%, and that's the unsustainable rate according to markets. In the United States, you don't have that. You know, our yields have been 2% for various reasons, which I won't get into now. But does that allow something like the Super Committee go, we don't really need to do our job because there's really not that dire of a situation?
Well, there wasn't a dire situation. I mean, the Super Committee, I think, was an effort to cut Social Security and Medicare, and they're trying to go around, circumvent the normal congressional process because they know how hugely unpopular it is. And thankfully, to my mind, at least, there was enough political opposition that they had to back off that agenda.
And really quickly, I know you think Occupy Wall Street had something to do with that. Do you really believe that Occupy Wall Street was stronger than the 200 lobbying groups that had money invested?
It wasn't stronger alone. The point was that it resonated. Its message resonated that, you know, we have 99% basically being taken advantage of for the 1%. And that was the backdrop that Congress was debating. Do you want to cut Social Security and Medicare? Do you want to kick that 99% again? And they backed away from it.
Did you hear any rumblings from members of that committee saying that?
Well, I'm not personally in contact with the members of the committee, but they certainly are aware of the political environment. They know that inequality is a big item on the agenda today.
All right. Well, I want to thank you so much for being on the show on Capital Account. So nice to talk to you. That was Dean Baker. He is co-director of the Center for Economic Policy Research.